Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 10th of April 2025, and what an interesting and dramatic day yesterday. So before we start today's gist of Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's kickstart what has taken shape yesterday in terms of news flow, economic data release, and as well as most important, their impact on the broad-based cross-asset classes. So we know that yesterday's most important news flow is more pertaining to this ongoing US reciprocal trade tariffs, and right now it doesn't seem to be that reciprocal anymore because President Trump himself actually ordered a 90-day pause on higher tariffs, all right, except against China. So what he did over here is that in the middle part of the US session, he actually announced, the White House administration announced that they will pause these higher tariff rates. Do you remember that reciprocal tariffs, there's this base of 10%, and there's a higher, we call it a rates 20+% depending on how they calculate the additional reciprocal tariffs against country that have traditional trade barriers and non-traditional trade barriers with US. So what Trump did over here is that he removed the higher trade tariffs at this point temporarily, offering a 90-day pause as countries head towards US for negotiation. So that's about what 90-day pause. We have about 3 months. So as long as countries that do not retaliate, so countries that do not retaliate, there's a higher tariffs will be Vietnam, South Korea, Japan. And European Union will be a big question mark because European Union, before Trump make this announcement of the 90-day tariffs, European Union officials actually highlighted they actually kind of like approve retaliatory tit-for-tat measures against US. And the worst hit was still China because China yesterday increased additional stamp duties for US products heading into China by 84%. And what Trump did over here is that he actually increased China total tariffs to 125%. But because of this 90 days reprieve of countries that do not retaliate against US reciprocal tariffs, the market actually have a very tremendous, monstrous risk-on mode over here. If you look at the headline rally on the major stock indices, all them rallied by more than 5%, where the S&P added by 9.5%, the Nasdaq 100 added by 12%, and these two single-day rally on the S&P and the Nasdaq 100 is the most single-day rally since 2008, and the Nasdaq rally of 12% is the most since 2001, and the second biggest single-day rally on record. So if you look at the heat map of the S&P 500 over here, okay, all deeply in the green, okay, all deeply in the green now in terms of the intraday movement. All right, but what's interesting over here is that yes, yesterday we have a very strong monstrous rally in the S&P 500. However, the safe haven demand is still intact in the marketplace by looking at the gold price. So gold price itself continues to rally and stage a second consecutive day rally right above the 50-day moving average, and right now it managed to clear above the 20-day moving average as we are speaking right now. So yesterday gold added by 3.4%. It didn't actually back down despite the fact that we have that 90-day reprieve coming out from the US White House against countries that do not retaliate with US reciprocal trade, we call it trade, higher trade the reciprocal trade tariffs. So despite these potential trade deals that's being done with this country like Japan, South Korea, and Vietnam, but the gold market does not seems to be backing off from this so-called risk-on rally that's being seen on the US stock market, but chose to continue its rally after clearing above the 20-day moving average yesterday during the US session, and in today's Asia session, it continues to rally up by 1.23% as we are speaking, and surging past yesterday's US session high at 3,100 level. Right, this level over here. So later I'll share with you what are the key levels to look out for on the intraday basis for gold. So still remember that on gold, 2 days ago we flipped to a intraday bullish bias because of the positive element that's being seen at the 20-day moving average 2 days ago. So later I'll touch on that. Yes, then now more towards the FX market over here. All right, so over at the FX market, what's interesting over here is that we start to see a rather choppy sideways movement, all right, on the markets itself over here. So this will be 10th of April. Let me adjust this date over here. Okay, 5-day rolling performance of 10th of April. So what we could see over here is that the dollar starts to actually give back its so-called this dollar strength starts to actually give back its gains against the Aussie. So the Aussie currency actually benefited yesterday as well from this 90-day news 90-day, we call it pause of higher reciprocal tariff rates news flow that causes the Aussie dollar to rally up towards our resistance level at around that 61.50 level. So what's interesting over here is that do not forget yesterday's we have an intraday bullish bias on the Aussie dollar, looking for that counter trend rebound to take shape. So the counter trend rebound has really played a part on the Aussie dollar, and the Aussie dollar right now is just right below its 20-day moving average. So I'll touch on the intraday technical outlook on the Aussie dollar. And what's interesting over here is that the safe haven currency like the dollar yen and the dollar Swiss franc now has starts to actually show dollar weakness again. Okay, so the dollar yen now is now inching downwards. So yesterday I also highlight that the dollar yen actually plummeted below 144.80, came down towards the 144 figure level before rebounding, but can't break above a short-term pivotal resistance level right around that 145, 146 level. So later I'll touch on more about that. But most importantly, as we're speaking right now, the dollar yen is now starts to inch downwards, trading below the dollar index at a positive 0.7%, whilst the dollar yen is only inching up a positive 0.5%. And the Swiss franc is still remains strong, where the dollar Swiss is now have a negative 5-day rolling performance of negative 0.8%. So there's still some form of safe haven demand that is still we call it in favor in the financial markets, despite the fact of that monstrous rally that we see on the major US stock indices yesterday. That means, i.e., there's still demand for gold, there's still demand for yen, and there's still demand for the Swiss franc. All right, so I would say that because of this, in the we call it this synchronized movement in the financial market, we cannot be sure that it's all signs clear for a potential risk on environment yet. All right, so there's still some uncertainty around, and as we are speaking right now, let me have a quick update on my screen right now to see whether is there any we call it news flow coming out from China. So far China hasn't so-called responded yet officially to Trump's we call it higher trade tariffs of 125%. All right, so far there's no official news yet up from China, so we got to monitor that pretty much closely. Will there be another reiteration from China? All right, from this juncture. Okay, so now one thing I'd like to share with you all is now the second segment on the daily dose of market insight will be more pertaining to the intermarket dynamics. All right, over here. So we know that yes, yesterday the US stock market rallied very sharply. So most of us will be puzzling, is this the start of a new bullish, medium-term bullish reversal where the US stock market could take all-time high, means go up to all-time high again, fresh all-time high, or is this a rally where it's still a mean reversion rebound rally, i.e. a dead cat bounce, where the medium-term downtrend still remains intact for the US dollar? So let's take a look at from an intermarket and intermarket dynamics perspective, okay, overlaying with a technical analysis factor as well. Right, so first and foremost, let us highlight the individual chart of the US stock market first, or the individual, we call it dynamics. All right, so what you could see over here is that we have a bounce of the Dow Jones Industrial Average. Right, from here, there's a key support at 36,900 level, okay, which is the minor swing high area, medium term swing high area of major former swing high area now turns the pullback support from January 2022, and the major ascending channel support level from the low of September 22 as well. Okay, so it managed to bounce off from here, but the rally still remains below the 20-day moving average, okay, at this juncture. And the RSI, yes, it rebounded from the oversold level, but there is no bullish divergence, all right, on the RSI, just an oversold, okay, lower low, and it bounced off from there. And this is the Dow Jones Industrial Average. How about the S&P 500? All right, over here. Okay, so the S&P 500 also managed to stage a bounce close to this major ascending channel. That's a long-term ascending channel from the low of March 2022. Okay, so that's the pandemic low, and as well as the former major swing high area of January 2022 now turns to a pullback support around the 4,800 level. Okay, managed to bounce from there, but still remains below the 20-day moving average, right, over here. Okay, still below the 20-day moving average. Okay, acting as an intermediate resistance at around this 5,540, okay, 5,540 level. RSI bounce off from the oversold, but there's no bullish divergence, all right, on the RSI. The Nasdaq 100, okay, over here. So this is the long-term ascending trend line from November 2008. So this will be in the log chart. I'll put it in log chart. So it's rather, there's a bunch of support zone here, 16,570, and the lower limit is 5,795. Also the former major swing high area of 15th of November and 23rd of December 2021 over here. The RSI, okay, there's no bullish divergence as well. Okay, no bullish divergence on the RSI. So right now the Nasdaq 100 rallied, hit exactly the 20-day moving average. All right, so now how about this rally? How many stocks inside the Nasdaq 100, inside the S&P 500, and participated in this monstrous rally yesterday? All right, so let's look at the market breadth of the S&P 500 and the Nasdaq 100, looking at the percentage of component stocks back above their 20-day moving average and their 50-day moving average, right? Okay, so let's look at, especially at the 20-day moving average. So let's look at this situation here. All right, start with the Nasdaq 100. So Nasdaq 100 stock above their 20-day moving average is still less than 50%, right? So despite yesterday's monstrous rally in the Nasdaq 100 benchmark index itself, but the percentage of Nasdaq 100 stocks above their 20-day moving average is still below 50, is at 32% yesterday. And the percentage of S&P 500 stocks above their 20-day moving average is less than 40. In fact, it's only at 19%, despite its monstrous single-day rally yesterday. So what you could see over here is that in terms of the dynamics of the individual technical analysis chart that I flashed you all earlier on, the rally off came out from a key support level, oversold on the RSI, but there's no bullish divergence. The component benchmark in the benchmark indices still remains below their 20-day moving average. But if I dive into deeper, the component stocks of these benchmark indices, focusing on the Nasdaq 100 and the S&P 500, is not so rosy yet. That means there is less than 50% of the stocks are still not trading above that 20-day moving average. All right, that means i.e. the percentage of Nasdaq stock above the 20-day moving average, despite yesterday's monstrous rally that is not seen in about more than more than a decade. So Nasdaq 100 yesterday's single day rally of 12% is the most since 2000, I think 02, and it's the biggest single day rally on record. But despite this biggest single day rally on record, it can't allow the component stocks to go, the percentage of component stocks trading above the 20-day moving average to hit 50%. All right, it's only at 32%, and the S&P percentage of S&P stocks above that 20-day moving average is still not so, is still rather minor or minuscule, only at 19%. Right, only 19% of the S&P 500 stocks are above that 20-day moving average. So overall, what we could see is that the market breadth is not that rosy. That means, i.e., in terms of probability and intermarket dynamics via this market breadth analysis, for looking at the percentage of component stocks above their 20-day moving average on the S&P 500 and the Nasdaq 100, we cannot be sure, or cannot be to me, it's not, I'm not really that convinced that we are at the start of a medium-term bullish reversal, despite yesterday's strong rally in the S&P and the Nasdaq 100, and there is still risk that this could be still a mean reversion rebound within a medium-term downtrend phase. All right, so that's my take in terms of this intermarket dynamics. All right, so now let us now move towards the third segment of today's daily dose, which is the individual intraday technical outlook on the broad-based cross asset classes. So as usual, let me expand my screen. All right, so let us start with the FX market first. Right, starting with the euro dollar. So no change on the euro dollar, as the euro dollar managed to hit our first resistance yesterday. So after hitting our first resistance yesterday, the market actually retraced. And where it retraced back at the pullback line of this minor descending trend line. Now turns into a pullback support before staging a bounce, as we are speaking right now in today's Asia session. So I do a bit of adjustment on the short-term pivotal support level at 10910. All right, 10910. Okay, so 10910 will be my short-term pivotal support level for today. Still maintain that intraday bullish bias. First resistance level to watch will be 1.1080. Above 1.1080 is the all-important major resistance level at 11150, which actually coincide with the longer term descending channel upper boundary from January 2008 high. All right, this is very important level. So once this level, we have a daily close, and most importantly, a weekly close at 11150, that could potentially see the start of a major US dollar weakness coming into play. Why? Because the euro dollar is the heaviest weightage currency inside the dollar index. All right. However, if price action suddenly plunge down and break below 1.0910, then today's intraday bullish bias will be invalidated to see another round of choppy minor decline sequence unfolding back again in the euro dollar, exposing 1.0860. Breakdown below it exposes the next near-term support level at 1.0770 / 1.0730, which correspond to the 200-day moving average as well. So in a nutshell, using because of this positive technical element that it managed to still hold at the former minor descending trend line, now turns into a pullback support at the 1.0910 level. We'll be using adjusted short-term pivotal support at 1.0910 to maintain the intraday bullish bias on the euro dollar. All right, up next will be the sterling dollar, or the cable. Okay, so the cable continues to hold at the 50-day moving average, but it can't actually have a proper breakthrough at around the 1.2840 level. All right, over here, but RSI continues to be showing signs of positiveness by continuing to trade higher. Okay, continuing to trend higher above the 50 level mark, right, and holding above this parallel ascending trend line, so indicating some form of bullish momentum that is still building up on the sterling dollar, at least on the intraday basis. So no change on the short-term pivotal support as it continues to hold at the 50 level, which is the 1.2725, 1.27 figure level, and also the lower boundary of this medium-term ascending channel that I drew from the low of 13th of Jan this year. So still using the 1.2725, 1.27 figure short-term pivotal support level to maintain that intraday bullish bias on the sterling dollar. First resistance level to watch will be the 12840. A break above 12840 may expose 1.2925 followed by 1.2965 level. All right, so that's the two intermediate resistance level to watch after a potential, if we are able to see a bullish breakout above the 1.2840 level, which is also yesterday's European session high as well. Right, as the Asia session, as we are speaking right now, is retesting this European session high at the 1.2855 level. Okay, so only a breakdown below 1.27 figure level will invalidate today's intraday bullish bias on the sterling dollar to kickstart another round of a minor corrective decline in the first step, exposing the next support level in near term at 1.2620, 1.2565. So i.e., given the positive technical element that is still prevalent after that bounce off the 50-day moving average, and also the hourly RSI continues to trace out a series of higher low holding above this key parallel ascending trendline support and above the 50 level mark, we will still maintain the intraday bullish bias on the sterling dollar using 1.2725/27 figure level as my short-term pivotal support. So that's for the sterling dollar. Up next will be the Asia Pacific dollar pair against the dollar, starting with the Aussie dollar. All right, so the Aussie dollar rally as expected, hit 61.40, which is our mean reversion rebound scenario, and right now is fast approaching the 20-day moving average at 62.55 level over here. So if you do the Fibo retracement of that previous sell-off from the high of 3rd of April all the way down to yesterday's intraday Asia session low at around the 59.20 or 59.15 level, we're now coming very close to the 61.8 Fibo, we call it retracement of this and of that previous sell-off over here. So at the RSI is coming close to the overbought level as well. So first resistance level to watch out for will be close to the 61.8 Fibo retracement level at 61.90, which is also the former minor swing low area of 28th of February, 4th of March, broken down now turns into a pullback support area. All right, at 61.90. Okay, from here. Let me remove this people level. Okay, why I can't delete this? Okay, let me delete it. Yep, so I can see clearer. So this will be my first intermediate resistance level to watch using the 20-day moving average at 62.55 level, which is the also this congestion area here from 3rd of April and 4th of April as well. So as long as this 62.55 short-term pivotal resistance that I have for today, which correspond to the downward sloping 20-day moving average, is not taken up on the up, is not clear on the upside, we'll flip to an intraday bearish bias on the Aussie dollar. First support level to watch will be 60.80. A breakdown below 60.80 may expose 59.95 next. Only a push up and an hourly close above 62.55 will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound rally to squeeze up, exposing the next near-term resistance level at 63.15. Above it sees the all-important medium-term resistance coming in at 63.90/64 figure level that got rejected by 4 times in the past 2 weeks. All right, so i.e., in a nutshell, given that the mean reversion rebound has been made at 61.40, right now we will flip to an intraday bearish bias at 62.55 short-term pivotal resistance, which correspond to the 20-day moving average as well. So that's for the Aussie dollar, flipping to a intraday bearish bias using 62.55 as my short-term pivotal resistance level. Next up will be the highly volatile dollar yen over here. So dollar yen yesterday, we do have a bearish bias. So we do mention that once 144.80 breakdown, intraday level to watch will be 143.90/60. Almost hit the level because it printed a low of 143.99 before bouncing up again. And this bounce during the during the US session in line with that monstrous rally that's being seen on the major stock indices, but that rally on the dollar yen didn't manage to surpass our pivotal resistance that we have yesterday at 148.15. So this level is indeed very important. on the dollar yen, it can't surpass, and the dollar yen reassert for weakness again as we are speaking right now. So this what I mean that over here is that even though yesterday we have a monstrous rally in the US stock market, but the FX market using dollar yen as a risk off risk on proxy does not participate in the, or does not move in line with the market sentiment that is being seen on the US stock market, because there's still demand right now for safe haven asset, which is yen, all right, over here. All right, so still no change, still maintain that bearish bias because it can't break above 14815. So we'll be using this level as my short-term pivotal resistance level. First support level to watch out for will be now is testing it right now at 14660. Let me put it in writing so that you guys could have a better view on the chart. 14660, yeah, 14660. Okay, which is testing it right now. Okay, a breakdown below 14660, revisit the 14540 / 14480 level again, which is a very important support level. So you look at the daily time frame chart. Yesterday it managed to survive on a daily basis because it can't break it below and managed to bounce off it over here, but no positive follow through so far by looking at this bearish candlestick that is being formed as we are speaking right now. So why this 14480 is very important, because it's the lower limit of this major ascending wedge, ascending trend line from the low of 16th of Jan 2023 low. So if we have a daily close below 14480, then potentially we may start to see a more clear bearish movement on the dollar yen that could stretch from a multi-week to multi-month perspective. Okay, so now we're taking things one step at a time first. Intraday basis, 14815 for sure. This is a short-term pivotal resistance, can't break out. So we got to respect the current price action right now as we are speaking at this juncture. At this juncture, still maintain the intraday bearish bias. Breakdown below 14660, increasing the odds to expose the key support area at 14540 / 14480 in the first step. All right, only a breakout above 14815 on the hourly close above it, then we will start to see another round of mean reversion rebound taking shape, mean reversion corrective rebound sequence taking shape again in the dollar yen, exposing 14910 and even 15030, which is the 50-day moving average acting as a medium term resistance level, with this upper limit of this medium term descending channel that I drew from the high of 8th of January this year. Right, so that's for the dollar yen, still maintaining the intraday bearish bias using 14815 short-term pivotal resistance. So that sum up the intraday technical outlook on the FX market. So now let us turn our attention to the intraday technical outlook on the major US, on the major stock indices first, starting from the Hong Kong 33. So the Hong 33, still recall yesterday we still maintain that bullish bias using 1938. 19385 / 19290 as my short-term pivotal support level. Price action rallied and hit our first resistance zone at 21,040 / 21,300, the upper limit, before staging that pullback over here. So what I'm going to do now over here is that I will have a very tight short-term pivotal support level, which is the gap up in today's Asia session. All right, so and also the former minor range high from 7th of April, that means this Monday, minor range resistance breakout now turns into a pullback support. So using this 20,400 as my short-term pivotal support level, the RSI still continues to trend in a series of higher low. All right, still holding above this parallel ascending trend line, I think as a support around the 50 level, and still hasn't hit the overbought region yet. All right, so we still maintain the intraday bullish bias using a very tight short-term pivotal support for today. 20,400 short-term pivotal support. Above 21,300 may expose the next near-term resistance level at 22,740 next. All right, so if we do the Fibo retracement of that sell-off, okay, that corresponds very closely to the 50%. All right, and graphically is the minor swing low area of 13th of February over here. Okay, only a hourly close and a breakdown below 20,400, then today's intraday bullish bias will be invalidated to see a choppy down move to revisit the next near-term support at 19,900, which is a 200-day moving average. Breakdown below it sees the range bottom at 19,385 / 19,290. So that's for the Hong Kong 33, still maintaining that intraday bullish bias, but using a tightened short-term pivotal support for today at 20,400. Okay, so that's for the Hong Kong 33. Upward next will be the Nikkei 225, or representing the Japan 225. So the Japan 225, yesterday we have a bearish bias, so it can't retest. It actually inched down lower, but can't hit the low of the 7th of April low that we have in our intraday technical outlook yesterday. So that's our first support level to watch in our bearish bias, and starts to pierce up above and clear above 32,700 level. And with that, it managed to actually now shape a higher high, higher low. So what I could see over here is that potentially it could be in a form of a okay, potentially it seems to be in a kind of a bullish flag formation over here, in the bullish flag formation. So what I'm going to do over here is that we will have a rather tight short-term pivotal support for today, which is yesterday's US session minus swing high at 33,800 level. So having a very tight short-term pivotal support give us a better risk management perspective. Flip to a intraday bullish bias with the near-term resistance level to watch in this ongoing bullish, in this ongoing, we call it a flag formation. Over here, bearish flag formation, I would say, not bullish flag, it's a bearish flag formation, with the intermediate resistance coming in at the 20-day moving average, confluencing with a graphical resistance area here, former minus swing low, breakdown got rejected at 36,130, 36,450. And if you do the Fibo retracement, okay, that constitute the 76.4% Fibo retracement right from there. Okay, so however, if price action starts to break down below 33,800, then we know that yesterday's push up over here is a failure bullish breakout, and we may start to see the bears unfolding back into the picture again, back into the lower limit of this bearish flag formation, with the next two support level to watch at 32,425, followed by 31,350, which was yesterday's European session low. Okay, so i.e. using a very tight short-term pivotal support level for a better risk management perspective, 33,800, flip to a intraday bullish bias, but it's still within this bearish flag formation, with resistance level to watch will be at 36,130/450, which is the uh, downward sloping 20-day moving average as well. All right, so that's for the Japan 225. Next up will be the Germany 30 over here. So the German 30, what you could see over here is now coming very close to another key resistance level to look out for, which is this downward sloping trend line that I drew from the high of 26th of March 2025 over here. And if I do the Fibo retracement, it actually also come close to the 61.8% Fibo retracement as well. So what I'm going to do over here is that right now there could be a potential chance of a pullback taking shape during the European session, as the RSI has really hit the overbought level over here, right? But there's no clear signs of a bearish divergence yet. So this pullback level to watch out for during the European session over here, it could be the low. This is the low, 21,050. A breakdown below 21,050 may see it floating downwards towards the next level here at close to 20,550. Okay, which is this minor swing high bullish breakout now turns into a pullback support, right? So using this 20,550, any chance of a minor pullback, so as long as the pullback didn't surpass below 20,550, we will flip to a intraday bullish bias on the German 30, but only the first resistance level to watch out for will be at 21,755, which is very important. So if we start to see any signs of bearish candlestick that is being formed at 21,755, this may indicate that this rally here has already ended, and a bearish reversal may take shape again on the Germany 30. So levels to watch out for on the upside will be at 21,755. So unless we're able to see an hourly close with a bullish candle above 21,755, 19,055, then the bullish buyers may continue to extend later to see the next resistance coming in at this 22,240, which is close to the 20-day moving average, and as well as the 50-day moving average, acting as a similar resistance area as well at 22,240. Okay, let me put it in writing. 22,240. All right. So if we start to see a very dramatic fall thereafter, below 20,550, then what we could see over here is that the whatever mean reversion rally has been over, and yesterday push up is a failure break up, or a failure, we call it a bear trap, or a bull trap, I call it. And we start to see we call it reassertion of the impulsive down move again. If we start to see hourly close below 20,550, to see the next support level coming in at 19,970, and a breakdown below it may revisit the 18,935. Let me put it, okay, because there's this low here, so it's a range, it's a support zone. Okay, 19,000, okay, 19,310 slash 18,935. All right, so still using 20,550, any potential minor pullback as my short-term pivotal support level to maintain this intraday, to flip to a intraday bullish bias for a residual push up for this ongoing counter trend rebound phase. First support level to watch will be first resistance level to watch, pardon me, will be at 21,755. Only a breakout above 21,755 with an hourly close above it may see the extension of that mean reversion corrective rebound, exposing the next near-term resistance at 22,240. Right, so that's for the German 30. Next up will be the very choppy major US stock indices, the US Wall Street 30. So like I explained earlier on the intermarket dynamics, using the market breadth of the percentage of component stocks above the respective S&P 500 and the Nasdaq 100, I'm not that convinced that we may start to see the start of a bullish reversal on the major US stock indices. So with that, I will have a neutrality stance on the US Wall Street 30 for today. Yes, it rallied up very strongly yesterday, but it can't still remains below its 20-day moving average that is acting as a resistance at 41,180. All right, from here, so I have a neutrality stance between 41,180 and 39,440. Only an hourly close below 39,440. That means indicating that yesterday's push up is a failure bullish breakout. That means it's a kind of a bull trap over here, where the bearish pressure may reassert back into the US Wall Street 30, exposing 37,900 as the next support level to watch on the intraday basis. If this level can't hold, we may revisit this Monday morning's this week Monday swing low area at 36,790/400. So flipping to a neutrality stance in the first step first, using 41,180 lower limit. I'll be watching very closely at 39,440 to give us any signs of an indication whether yesterday's push up is a bull trap or not. All right, if we can't maintain above 39,440. So that's for the US Wall Street 30. Very similar for the Nasdaq 100 as well. Right now, as we're speaking, it got rejected exactly at the 20-day moving average at 19,280 intermediate resistance level. So with that, we also flip to a neutrality stance on the Nasdaq 100. So neutral between 19,280. Lower limit I'll be watching very closely will be this breakout area yesterday. This level it got broken out, 18,130. If it starts to have an hourly close below 18,130, we know that yesterday rally is a failure bullish breakout. That means, i.e., a bull trap, where the bears will reassert it force back again to expose the next near-term support level at 17,410, and hourly close below it, revisit this week Monday important swing low area at 16,590/16,335. So, i.e., flipping to a neutrality stance as well on the Nasdaq 100. Upper limit 19,280. I'll be watching very closely the lower limit at 18,130. A breakdown below 18,130 will increase the odds of a failure bullish breakout yesterday, and as well as a bull trap as well on the Nasdaq 100. Okay, so that's sum up the intraday technical outlook on the major stock indices. Let us now turn our focus to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, price action continues to be very rosy over here. After managed to survive as the 50-day moving average, it appears above the 20-day moving average. Right now, it coming very close to the overbought level again. So there could be some form of a pullback as it approached the intermediate resistance where it got rejected on 3rd of April and 4th of April at 3,135, slightly below the all-time high area at 3,168. So there could be some form of a minor pullback taking shape during the start of the European session over here. Okay, potential pullback area to watch out for. 3090 level, where previously during the US session yesterday it got congested before breaking out at today's Asia session start at around the 8 a.m. 10 a.m. over here. So with that, first minor pullback level to watch 3090, but I don't want to put this level so tight as my short-term pivotal support level. So I'll use this as my first support level to watch. If this level can't hold, the pullback may be deepened, but the all-important pivotal support level will be adjusted and the tighten one today at 3060/3040, which is confluence with the 20-day moving average as well as the former minor swing high broken out during the US session yesterday, where it hit and managed to stage the pullback. All right, so this is a zone to watch out for: 30,060, 3060, 3040, which is the 20-day moving average for 3040. So using 3060, 3040 in any potential chance of a pullback, as long as this pullback then surpass below 3040 short-term adjusted short-term pivotal support for today, we'll still maintain that intraday bullish bias on gold XAU/USD above 3135, sees the sees a retest on the current all-time high at 3168. Above it sees 3210 level next. So 3210 level is a Fibo extension level, okay, of 3.618. All right, only a price action breakdown and hourly close below 3040 will invalidate today's intraday bullish bias to see another round of choppy corrective decline movement, but still be in its medium-term uptrend phase to revisit the 50-day moving average, acting as a support level at 2,955. Below it may expose further weakness towards 2,936, followed by 2,906. So i.e. in a nutshell, still maintaining that intraday bullish bias for within a potential we call it minor pullback that could take shape. So as long as this minor pullback didn't surpass below 3040 short-term pivotal support level later today during the European session and the US session, we will still maintain that intraday bullish bias for gold XAU/USD. Next up will be the West Texas crude oil. So West Texas crude oil, yesterday we do have a bearish bias. So the bearish bias didn't hit our support level at 5450/5380. Only printed a low of 5523 over here, 5523, before staging a very strong rally and broke above this minor descending channel upper limit over here. So with that, we will now flip to a intraday bullish bias on West Texas crude oil to see a start of a mean reversion rebound sequence, on at least on a minor scale for West Texas crude oil. But given the fact that the RSI now is hit the overbought level and now starts showing a pullback, so potentially there could be a minor pullback taking shape on West Texas crude oil today. First pullback level to watch will be at 5960, followed by the short-term pivotal support level at 5830 if it can't hold at 5960. So 5830 is also the former minor swing high of 9th of April, now turns into a pullback support, and this pullback support also corresponds to the former descending channel, turns into a similar level of pullback support as well at 5830. So as long as this minor pullback didn't surpass below 5830, we'll flip to an intraday bullish bias for a potential mean reversion rebound to take shape over here. Next level to watch above 6336 will be 6540 level. So 6540 is that former major so-called, if you go into this level, 6540 is the former major descending triangle pullback, former major descending triangle support now turns into a pullback resistance at 6540. 65.40. All right, over here very clearly. Previously it was in place since March 2023, broken down on the last Friday, now turns into a pullback support, pullback resistance, significant pullback resistance at 65.40. So at the moment, whatever mean reversion rebound that we want to have a view on, the resistance level to watch will be at 65.40. All right, unless it could have a daily close above 65.40, then we'll talk about a higher potential chance of a bounce then. So however, if price action suddenly plunge below 58.30, today's intraday bullish bias will be invalidated to kickstart another round of bearish impulsive down move, revisiting 55.40/53.80 next. So i.e. in a nutshell, because of the short-term intraday technical element has turned into much more a rosy, we call it a rosy scenario, we will flip to a intraday bullish bias in any pullback, using 58.30 as my short-term pivotal support level to see another round of extension of this mean reversion rebound. But mean reversion rebound resistance to watch out for will be at 65.40. Only a breakout above 65.40 may see a further strength in West Texas crude oil. That means, i.e., if we start to see a bearish reaction at 65.40, for sure we know that the mean reversion rebound may have ended, and where the impulsive down move may resume on West Texas oil, because the 65.40 is a very important level to watch, or an inflection level to watch on West Texas oil. So with that, that sum up the intraday technical outlook on all the broad-based cross asset classes. So for sure, we will continue to monitor trade tariffs news flow, especially out from between China and US, and especially from EU as well, given the fact that yesterday EU also imposed a retaliation, we call it tick for tack measures against US. So other than the trade tariffs news flow, what other economic data to look out for today? So today will be Thursday. So Thursday things to look out for will be as we are speaking right now during the European session. So we do have one ECB official speaking at 5:15 p.m. Singapore time, and also at 6 p.m. Singapore time, RBA Governor Bullock will be speaking. So that could actually impact the movement of the Aussie dollar and the Aussie crosses. 8 p.m. Singapore time, we have another ECB official speaking, and the all important data to look out for today will be US inflation data out at 8:30 p.m. Singapore time, 1 hour before the start of the US stock market cash session opens. So market will be concerned about the inflation rate. So inflation rate is rather sticky at 3.1%. Market is expecting a slight downtick to 3%. So something to look out for that could impact almost all asset classes. So that will be at 8:30 p.m. Singapore time. And thereafter, we have another we have a US Federal Reserve official speaking, 9:30 p.m. Fed Logan. All right. Then 12 a.m. another US official speaking, Fed Gooseby. Then thereafter, it will be a rather quiet session. Okay. Other than that, all right. So these are the key data to look out for today. So and events to look out for. So with that, that sum up today's daily dose of market insights. Kelvin here, signing off. Wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.